So we are now in your investments. So for investments, if you still remember before, we are trying to define financial asset. And a financial asset is a cash, contractual right to receive cash, or an equity instrument of another entity. So we're done with your cash. And your contractual right to receive cash, these are your AR, LR, NR, and also your bonds receivable. We're done with AR, LR, and NR. We are now in your bonds receivable. Your bonds receivable is now known investment in debt or a debt investment. While your equity instrument is known as your investment in equity securities or an equity investment. Therefore, what is left here under your PFRS 9 is your investment in debt or debt investment and your investment in equity security or equity investment. So let's start first our discussion in your investments, particularly with your debt investment. Particularly with your debt investment. So for debt investment, this is a contractual right to receive cash evidenced by a bond receivable. So your investments in bonds or investment in debt nowadays. So for debt investment under PFRS 9, a debt investment can be measured at fair value or at amortized cost. Fair value or at amortized cost. So in your fair value, it can either be fair value through profit or loss or fair value through other comprehensive income. While for amortized cost, that is only your financial asset at amortized cost. Therefore, under debt investment, there are three main classifications. And what are those? FVTPL, FVTOCI, financial asset at amortized cost. So the three classifications of your debt investments are, again, fair value through profit or loss, fair value through other comprehensive income, financial asset at amortized cost. Now, let's look into their differences. So the first difference is your recognition first. Recognition. So the debt investment is considered FVTPL if ever it is held for trading, or it is considered designated as FVTPL. While in your FVTOCI, if ever you are collecting based on your contractual cash flow characteristics. When we say contractual cash flow characteristics, these are solely payment of principal and interest, or known as SPPI. Plus, you are measuring it at fair value to remove any accounting mismatch. While in your financial asset at amortized cost, it is solely collection of contractual cash flows. So in your FVTOCI, therefore, it is both contractual cash flows plus measurement of fair value. That is our recognition. So once we can determine whether it is FVTPL, FVTOCI, or amortized cost, then your next problem is your measurement. So how do we initially measure FVTPL, FVTOCI, and amortized cost? Under FVTPL, it is measured at fair value only. FVTOCI, fair value plus transaction cost. Amortized cost, fair value plus transaction cost. Therefore, what is the treatment of transaction costs under FVTPL, FVTOCI, and amortized cost? So in your FVTPL, the treatment of transaction cost is expense. Therefore, it will be part of your profit or loss. While in your FVTOCI, it will be capitalized, meaning it is part of your initial measurement. As you can see, mag-a-add ka ng transaction cost dito. While for amortized cost, it is also capitalized. Part of initial measurement. Now let's go to your subsequent measurement. The subsequent measurement of FVTPL is fair value, FVTOCI, fair value, while amortized cost is amortized cost using effective interest method. Since we are accounting for the fair value, therefore, we need to look as to your changes in your fair value. The changes in your fair value under your FVTPL will be placed in your profit or loss. FVTOCI will be placed under your OCI, while the changes in fair value under amortized cost is ignored. Therefore, can we test this for impairment? For FVTPL, it is not tested for impairment. Why? Why is it not tested? Because you are only accounting for fair value. But for amortized cost and FVTOCI, you are accounting for contractual cash flows based on payments of principal and interest. Therefore, under FVTOCI, it is tested for impairment. FVTOCI, including financial asset at amortized cost, is also tested for impairment. Again, the reason is that because you are still accounting for contractual cash flows through your payment of principal and interest. That's why you test them for impairment. And how will you test for impairment? Again, you use your PFRS line. That is your expected credit loss model. Expected credit loss model. So that is as to your impairment. Next, as to your interest income. Under FVTPL, interest income is equal to your face amount multiplied by your nominal rate or the coupon or stated rate. While for FVTOCI, it is the carrying amount based on your effective interest method multiplied by your effective interest rate. For amortized cost, the same, carrying amount, effective interest method multiplied by your effective interest rate. Now, as to the amount of as to the presentation of your cumulative changes in fair value. In FVTPL, it is not presented. In FVTOCI, it is presented as part of your OCI or item of shareholders' equity. And for amortized cost, since we are not accounting for fair value, it is ignored. Next, the unrealized gain or loss, or the amount recognized in equity. So the amount recognized in your changes in fair value under FVTPL, it is not applicable. Under FVTOCI, the cumulative changes in fair value will now be recycled in profit or loss. Take note of this. So for FVTOCI, we have both debt and equity. For debt investment, it is recycled to profit or loss. If that is equity, you close directly to retained earnings. And since there is no cumulative changes in fair value in your amortized cost, therefore that is not applicable. How about your derecognition? When we talk about derecognition, this is the sale of your financial asset. So if you will sell now your financial asset, FVTPL, the gain or loss on sale will be placed under profit or loss. FVTOCI, the gain or loss on sale will be placed under profit or loss. And for amortized cost, the gain or loss on sale will be placed also in your profit or loss. Okay, so these are the differences of the three. I already outlined all of the accounting of the different classifications of investment in debt from FVTPL, FVTOCI, and your amortized cost. Just take note of the differences. So on the first one, always remember the first difference is the treatment of your transaction cost. Ang magkapareho dito ay si TOCI and amortized cost. Ang kakaiba ay si FVTPL. Sa subsequent measurement naman, ang magkapareho si FVTPL at saka FVTOCI. Ang kakaiba si amortized cost. As the changes in fair value, lahat sila magkakaiba. The changes in fair value for fair value through profit or loss is presented in profit or loss. And take note, there is no cumulative gains or losses. While for FVT OCI, it is placed in your OCI and there is a cumulative gains or losses. Lastly, changes in fair value for amortized cost is considered ignored. As to your impairment, since fair value through other comprehensive income and amortized costs measures contractual cash flows, therefore they are tested for impairment. If they are tested for impairment, it also means that they can be reversed, right? When we talk about reversal again, that is your impairment gain. Do we have any limit on impairment gain? No limit on impairment gain for your other items or for your impairment of FVT, OCI, and amortized costs. Next, as to cumulative changes in fair value, under FVTPL, again, it is not presented. Under OCI, it is presented as part of your SHE. Amortized costs, there's no cumulative gain or loss. As to the amount recorded as to amount reclassified as to changes in fair value, this is reclassification. When is there a reclassification? Normally, if that is a loss, gain or loss on reclassification of your financial asset, or a gain or loss on the sale, you reclassify now whatever is accumulated in your OCI. In fair value, it is not applicable, while for FVT OCI, in debt FVT OCI, it is recycled, while for equity retained earnings, again, not applicable for your amortized cost. As to your derecognition, all gains or losses on sale will be presented in your profit or loss. Now, generally, I don't have any problem as to your subsequent measurement. Why? Because it's quite easy. For items of fair value, which is FVTPL and FVTOCI, it is always measured at fair value. While for amortized cost, it will be measured using your effective interest method. The main issue here is the changes in fair value. So the changes in your fair value applies to FVTPL and FVTOCI. In FVTPL, just compare the ending fair value to the carrying amount. If ending fair value is greater, there will be a gain. If lesser, there will be a loss. How about in your FVTOCI? Get the ending fair value and get the carrying amount based on your effective interest method. The difference between the two is known as the ending balance of cumulative gains or losses. So let's say for year 1, year 2, there will be amounts here. So again, this is the ending balance of your cumulative gain. So the difference between both ending balance is considered the gain or loss. So just take note of this slight difference in the computation of your changes in fair value. For FVTPL, again, you just compare the ending fair value to the carrying amount. Whatever is the difference is the gain or loss. For FVTOCI, the ending fair value you compare on the carrying amount based on effective interest method. And this difference is your ending cumulative gain or loss. The difference between the two ending cumulative gain or loss is the amount of your gain or loss in changes in fair value. Take note of the difference. Again, you are getting for an ending cumulative gain or loss here in FVTOCI. While in FVTPL, whatever you get is already the gain or loss. Therefore, to get for the gain or loss under FVTOCI, you need to compare both the ending cumulative gains or losses for both years, year 1 and year 2. Because if you don't get that, you will you will have an incorrect answer. Again, kunin ninyo yung ending cumulative gains or losses ng both. Ang difference niya ay yung gain or loss on the period. Gain or loss on the period. Also, guys, always take note of this. Your total income under FVTPL is composed of the total income under FVTPL is composed of your interest income and your changes in fair value. The total income in your FVTOCI is composed also of your interest income and your changes in fair value. If ever you find it hard to compute for the FVTOCI gain or loss, you can make use of this shortcut. You get the interest income under FVTPL, you get the changes in fair value in your FVTPL, that is your total. So the total gain or loss in your FVTPL, total gain or loss in their FVTPL, less the interest income using FVTOCI, that is the changes in fair value under FVTOCI. Why? Whatever is the total income here in FVTPL is always equal to the total income in your FVTOCI. Magkaiba nga lang sila ng pag-compute. Sa interest income ng FVTPL, it is face amount multiplied by your stated rate. Sa changes in fair value, just compare the ending to the beginning. However, whatever is the total of this one is also the total of FVTOCI. Therefore, if you find it hard for you to compute using the changes in fair value, as I have outlined a while back in your FVTOCI, then you can make use of the shortcut. Get first the total of your FVTPL. You deduct the interest income using the FVTOCI. That is now the amount of your gain or loss in your changes in fair value for FVTOCI. And please do not forget that the changes in fair value for FVTPL is presented in profit or loss. For FVTOCI, presented in OCI, an item of SHE, therefore an item of your balance sheet or statement of financial position. Balance sheet or statement of financial position. Now, let's talk about your reclassification. Let's talk about your reclassification. So for reclassification, this is the transfer from one classification to another. So what are our classifications? We have your amortized cost and then your fair value. Amortized cost and your fair value. So for amortized cost, pwedeng amortized cost FVTPL, amortized cost FVTOCI. Or pwede ring vice versa. Pwede ring vice versa. Sa fair value naman, kung FVTOCI yan, pwede lang siya, kung fair value naman, dapat within fair value lang din. Within fair value lang din. So, if that is FVTPL, papuntang FVTOCI. If that is FVTOCI, papuntang FVTPL. Okay? Ganyan naman pag fair value. Sa amortized cost, pwedeng pabalik FVTPL to amortized cost, FVTOCI to amortized cost to FVTPL, amortized cost to FVTOCI. And just take note of this reclassification. In reclassification, first you need to determine the reclassification date. And what is the reclassification date? The reclassification date is the first day of the next accounting period. So let's say, for example, you are using calendar year. On June 30, 2023, you reclassified from amortized cost to FVTPL. You reclassified from amortized cost to FVTPL. When is the reclassification date? That is the first day of next accounting period. And when is our next accounting period? Our next accounting period will be next year. That is January 1, 2024. So this will be your reclassification date. Next, you get the fair value at reclassification date. Third one, you compute the gain or loss on reclassification. The gain or loss on reclassification is equal to the fair value at reclassification date versus the carrying amount at reclassification date. If the fair value at reclassification date is greater than the carrying amount at reclassification date, then that is considered gain. If lesser, then it is considered as loss. It is considered as loss. Okay. And then lastly, we talk about your derecognition. So in your derecognition, again, this is the gain or loss on sale. Gain or loss on sale. On your gain or loss on sale, generally, you just need to get for the proceeds versus the carrying amount. If the proceeds is greater, then we have a gain. If lesser, then we have a loss. But take note for the recognition, take note of the effect of the gain or loss on sale. Always, the gain or loss on sale will be presented in your profit or loss. How about any unrealized gains or losses? So in your fair value through profit or loss, we don't have any problem here. Why? Because it is already embedded. While for FVTOCI, again, what did we say? If ever there is unrealized gain or loss, you need now to recycle it to profit or loss. You recycle it to profit or loss. Okay? That's it for your investment in debt.